Hi, this is the Philosophical Angle program, and I'm your host, Chris Angle. The purpose of the Philosophical Angle is to examine the nature of concepts and ideas in current media. I'm the author of 5 books on philosophy known as the Detmar-Haskell Dialogues, and they are The Nature of Aesthetics, The Nature of Ethics, The Nature of Truth, The Philosophical Equations of Economics, and The Nature of the Political Left and Right. If you'd like to contact us to make comment, inquire, or make suggestions, feel free to give us an email at detmar.haskell, Haskell spelled with 2 L's, at icloud.com. And so this week, we're going to talk about everybody's favorite subject in the stock market, the Fed. And it's going to be entitled The Formula for the Fed to Calculate Interest Rates. And as you know, many times a year we read about how the Federal Reserve is going to raise, lower, or keep the interest rates at the present level. They gather to discuss the economy and whether the interest rate should be raised or lowered. It's a great event with media and investors of the stock market closely looking at the august conclusion of the meeting. After the meeting concludes, 2 things happen. The Fed governors go out and make speeches, and at some point, the minutes to the meeting, those minutes are released. Well, there's only one thing lacking in all this information. How does the Fed come to their decision whether they should raise or lower the interest rates? There is a lot of speculation on this, ranging from some people thinking that they just throw darts at the board, to others thinking that they have some sort of calculative methodology. Well, the philosophical angle is here to throw its 2 cents into the discussion by saying that we are pretty sure that the Federal Reserve has no methodology by which they decide to raise or lower interest rates, and by how much. Oh yes, they take a look at the various statistics that are put out by the government and then intuitively come to some sort of a conclusion. But the philosophical angle believes that there should be an equational calculation that would direct the board members to come to a valid conclusion as to what to do with the interest rates. So, let's begin. What should that calculative equational description be? The primary factor, as I would think the governors would agree, should be inflation. They're always looking at inflation. As well, they should. Well, how do we calculate predictive inflation? Let's determine what causes inflation and what would be a start to formulating our equation. The main factor in producing inflation is the M2 money supply. You add lots of fiat money to an economy with no additional efficiencies producing goods and services, then you will get inflation. But there's a second type of inflation or deflation factor, and this is caused by efficiencies produced by knowledge that come into the economy in producing goods and services by companies. This is also known as productivity. When productivity increases, you're getting more for less. Productivity, by its nature, introduces efficiencies and breaks down inflation. An example of this would be in the production and invention of the flat screen TV. When these first came out, they were very expensive. But as the companies learned more about the production, acquiring more technology, and increasing the efficiency of production, the cost of the flat screen TVs went down. And the converse is true. If in making of the flat screen TV, the components suddenly become more expensive, then the cost of the flat screen TV would increase, causing an inflation in its production. This could happen in any economy. And sometimes we've seen it in the past. When there's a war in the Middle East and production of oil is decreased, and suddenly the price of gasoline throughout the world increases rapidly. This is inflation caused by an inefficiency of production introduced into an economy. So let's call this type of inflation secondary inflation. Inflation caused by money supply will be the primary inflation. So far, we have two ingredients to enable us to make a decision as to how to set interest rates. First, we have the M2 money supply, which is published by the Federal Reserve of St. Louis. And secondly, we have productivity statistics that come out each month, published by the BLS, Bureau of Labor Statistics. And so previously, we just mentioned that there is the primary inflation, which is the amount of money relative to the supply of goods and services in the economy. Then we have to calculate into an equation the amount of goods and services being produced in the U.S. economy. And this is known as the GDP, otherwise known as the gross domestic product. So now we have the ingredients to formulate a basic primary equation by which we can calculate predictive, primary, and secondary inflation, which should be the primary ingredient by which the Fed governors may utilize to decide how much M2 money supply should be produced into the U.S. economy. So this equation should be the M2 money supply minus the percentage increase or decrease of productivity minus the percentage increase or decrease of GDP, which would give us the predictive inflation rate. Through the use of this calculation, we can determine the present and expected inflation rate for the present and near future. Presently, the Fed is always expressing their view that in order to lower interest rates, inflation should be 2% or less per year. So they could use our equation to understand the predictive rates of inflation. If it indicates 2% or less, then the Fed should be able to feel comfortable in controlling the M2 money supply. But we still haven't been able to decipher the problem of the level or how much should the interest rate be. Even if our equation indicates a predictive inflation rate of 2% or less, what should the level of the interest rate be? We understand that our new calculation of the inflation rate, whether it should go up or down, but we don't know whether it should be on our scale. Where do we go now? Well, it's good of you to come into to tune in to the Philosophical Angle program, because we have a suggestion for this also. Let's turn to the market to understand what should we do about that. The Fed should convert itself into a for-profit organization. It should operate as a public utility, and it should do so since it is basically a monopoly on the production and issuance of money. So the profit level of the Fed should be commensurate with the average level of its utility, of other utilities. Therefore, just like a public utility, they sell the money supply at a rate that is commensurate with the audience of the primary buying banks of the Federal Reserve product. The Fed now has two products. One of the products of the Fed is to allow banks to deposit money at the Federal Reserve, and the Federal Reserve will pay the bank an interest rate. Well, the Federal Reserve would target an interest rate that would attract enough money to come to the Fed so that they could make a profit on the interest rate differential commensurate to the profit level of the public utility company. They will attract money coming into the Fed by raising or lowering according to the market interest rate that the Fed would pay in order to attract money into their account for their overnight housing of bank paper. Another product of the Federal Reserve is the buying of the loans that banks make, giving the bank more money to loan out, increasing the ability of the banks to make more and more loans. Also, the Fed buys the bonds of the U.S. Treasury and should offer to buy at a rate higher than the predictive inflation rate at a level that would be commensurate with a utility company level profit margin. Another factor in determining the level of the interest rate would be the direction of the interest rate relative to the inflation rate. So as the inflation rate comes down, they can gradually reduce the interest rate accordingly, instead of doing it all in one big decrease. And conversely, the interest rate would ascend conversely if the inflation rate is ascending as per our equation. The Fed would want to increase its interest rate accordingly, as the interest rate must always be higher than the inflation rate in order for the Federal Reserve Utility Company to make a profit. So, you have the conclusion that as the inflation rate comes down, so should the interest rate, and if the inflation rate, according to our inflation, goes up, so should the interest rate. And it should all be done as per M2 money supply, productivity, GDP, and the Fed profit target, which would be the average profit rate of the utility companies. Thanks for listening to this idea, and see you next time here at the Philosophical Angle program.